There was a time not too long ago when one used to mention the bond market in India, people used to think about James Bond movies. But as they say, times they are changing. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. For the uninitiated, or in simple language, bonds are basically debt instruments. Investors invest on or give loans to big corporations, private companies, and earn interest on them. Bonds are basically debt instruments issued by the debt seeker, and they command interest. Higher the bond yield or interest, more is the demand of the bond. In any country, the strength of the bond market depends on the belief that the country's governments or corporations would be able to pay back the loans along with the interest, which also depend on the belief in the strength of that economy. Not only that, they also depend on how strong the secondary or tertiary debt market is, which is the ability to sell those bonds to new willing buyers who can also circulate them to other buyers. It's a cycle. Now, sample this. These are the world's top 10 bond markets, with the United States of America commanding the highest share of 39% and $51.3 trillion of debt size, while Brazil, with 2% market share, has a debt size of 2.4 trillion and stands at the 10th position. You see, India is not even amongst the top 10 as of now. This could change. India could soon be the second biggest bond market amongst emerging economies. So, what has changed for the Indian bond market? The Reserve Bank of India from April 2020 introduced a separate channel called the Fully Accessible Route for foreign investors in India's sovereign bonds. In June 2024, global investment bank JP Morgan announced the inclusion of India's sovereign bonds in its global indices. This was a big development. As per CCIL data, in September 2023, the aggregate FPI holdings in foreign accessible route bonds was only 94,709 crore rupees. But on August 30th, 2024, the aggregate FPI holdings in FAR bonds stands at 2,29,709 crores. Since early August, the 10-year Indian government bond yield, which is the return after 10 years, stayed nearly unchanged at 6.85% compared to that of US at 3.9% by the end of August. You see, yield on Indian bonds is higher. When a country's bonds are added to global bond index, it opens the window for a new set of foreign investors to make a passive investment. So far this year, foreign investors have invested a net 13 billion in the Indian bond markets, with the majority of the flows coming into the government bonds included in the JP Morgan indices. As per an SBI Research report in July this year, another $20 to $22 billion of inflows will be there by March 2025, as other indices like Bloomberg and Barclays are expected to add India's government bonds to their own indices. Now, a large chunk of these bonds could also be green bonds, which means investments for the green sector in the country. In fact, S.K. Ghosh, who is the chief economist at SBI Research, said in the reports that India should ascend to a second largest bond market amongst emerging markets. In fact, a recent report by the Mint showed that the Security and Exchange Board of India is working on allowing simplified registration rules for foreign investing, but only in the government bonds. Anand Narayanan, a whole-time member at the SEBI, mentioned that for foreign funds investing in only government bonds, given that India's debt has been included in global indices, we are trying to make the registration process for them a lot easier. Now, this was a story done by Mint a few days ago. But there is a flip side. While opening up India's bond market to foreign investors, this will bring in money during the good times. The outflows will also be that much severe during the bad times, as we have seen how global dumping of bonds in the financial market plays out. But that is a risk the RBI and the government will be aware of. Now, a better government bond market is a precursor to a much better corporate bond market. Indian corporates and private sector bonds are closely monitoring this space, as they are also eager to jump on the bond bandwagon. And so are we at Mint. See you soon in the next episode, and we shall keep you posted.